Hello, everyone. Welcome to KJH Insights, our monthly podcast. I'm Sarah Bull, Managing Partner at KJ Harrison Investors. Thank you for joining us. Today's episode is part of our Women and Wealth series, where we explore financial topics that we believe matter most to women through all of their life stages and transitions. This show really aims to educate and inspire women to make wise decisions around their wealth. I'm thrilled to welcome Theresa Shutt, Chief Investment Officer at Harbourfront Wealth Management, our KJ Harrison parent company. Theresa and I are going to discuss the current market environment and spend time today looking back at an eventful 2025 and then look ahead to what we can expect in 2026. Thank you for joining us today, Theresa. How are you doing?
I'm wonderful. Thank you for having me. It's great to be here.
So, Theresa, 2025 has been an interesting year in the markets. The year began with momentum. Markets really surged out of the gate on the heels of the Trump victory, as a lot of the voters expected tax cuts, deregulations, and more of a pro-business policy environment. But that confidence gave way to a correction in April, known as Liberation Day, which was really a combination of tariff threat and geopolitical tensions. Since that time, the market staged a sharp recovery, or a V-shaped recovery, and the S&P has worked its way back to all-time highs, but with very narrow leadership, really among the tech or AI stocks. So, Theresa, as we reflect back on 2025, in your mind, what were some of the themes that really stood out?
Yeah, great question. The last 12 months have been extraordinary, to say the least. Certainly this time last year, I would not have predicted much of this to happen, frankly. I think at the time, the biggest concern weighing on markets was probably the federal deficit and what was going to happen to the 10-year rate and when, interest rate cuts were going to start or continue. Monetary easing was the big theme, and that was before, obviously, Trump took office, and we saw tariffs. And we saw, obviously in the markets, the AI boom and other factors that have really influenced returns going forward. So for myself, I'll start with the big one, which is obviously the AI boom. Artificial intelligence has evolved rapidly from niche applications like virtual assistants, like Siri, to recommendation engines and Netflix. And now it's a truly transformative force, reshaping industries and society. If you think about the launch of ChatGPT, it wasn't that long ago. It was just November 2022. But that really marked a turning point, and it really made AI accessible to millions of people. I know I use it now. I didn't 6 months ago. And certainly my company and probably your company is looking at making some pretty major investments on the tech side in AI. Let's think about AI in healthcare, the diagnostic precision. They're using AI to find cures for superbugs and all sorts of different illnesses. The manufacturing space, think of all the technology that they can use to improve automation, deliveries, product maintenance, all these things. And then we just saw last week, Walmart decided to list on the NASDAQ, trying to lump itself into the tech darlings. It's arguing that 40% of its revenues is e-commerce, and they're investing huge in AI. So I think this has really been the game changer that we've seen over the last 12 months. $350 billion has gone into building data centers and chip manufacturing this year, all for that computing power that they anticipate that AI needs. But on the flip side, there's also a lot of questions about, will the revenue from these AI applications actually show up? A lot of people use free ChatGPT. Maybe, your company has a $30 monthly license fee for Copilot. So it's a lot of money that's getting kind of invested in the space. And to your point about the market concentration, I mean, that's huge. So if you think of all the gains that we've seen in the market, it's really because of 7 kind of related AI stocks that now account for 35% of the S&P 500. And that creates some risk, obviously. And I think it's just the beginning. So I think, there's a big question, is this a boom or is this a bubble? So I'm a bit in the boom camp, frankly, because I do think that there are some significant differences between what we're seeing now and what happened in the 1990s with the tech boom, obviously, and boom and bust that happened then. The companies today obviously have a diverse source of revenue streams. Yes, they're spending, but it's coming from cash flow, not from debt financing. The valuations are certainly at elevated levels, but they're nowhere near what we saw in the late 1990s. So I do believe that there's still runway for AI. I think we're in the early innings. I think there's going to be some winners and losers. I think it's going to have some pretty massive implications for us going forward. But I do think the biggest kind of risk there is the market concentration. So this has really driven consumer spending. It's the CapEx spend has driven GDP growth. So if there's any kind of wobble or kind of significant pullback in this AI enthusiasm, I think we're going to see some pretty big negative spillover effects. The second trend I'd probably talk about is, and I think you alluded to it, is the K-shaped economy. I think this is quite interesting. We saw this in COVID actually, but we're seeing it again now. And this is less about the market. This is actually about Main Street, not Wall Street. So the US economy really appears resilient from the 30,000 foot level, but the narrative isn't the same for everyone. And the fact that consumer sentiment in the US keeps falling, although spending is going up. So there's this disconnect that keeps happening that's really driven by the success of these AI stocks. People have, anyone of the retirement portfolio has exposure to NVIDIA, CoreWeave, whatever, and their wealth is increased, at least in paper. And that's driving spending. But in the meantime, the average American is experiencing high inflation, high prices for groceries, a very kind of frozen labor market, very little hiring, a lot of these companies shedding employees. So I think that's something that's really kind of going to, impact fiscal policy going forward. I think particularly with tariffs, we haven't really quite felt the bite of that yet, particularly in the US, but I think that's coming. And so I think this kind of bifurcation or this divergence in wealth in the US is going to continue to increase.
That's amazing. Really appreciate you narrowing it down because I think that's a good way to think about the market right now. So let's dive a little bit deeper into each one of them. So on AI, a couple questions that come up in my mind based on what you said. One of them relating to CapEx, because I think that's super interesting, right? So CapEx is exploding across these tech giants. But when you look at them, are you actually seeing any productivity gains or is it just higher spending in these stocks? And that relates to what you said. Is it back to it being more of a bullish sentiment in your mind right now?
Yeah, I think it's this idea of if you build it, they will come. So I think there's a little bit of that enthusiasm. And certainly AI is very new for investors and for market experts, frankly. We can talk about energy, we can talk about pharmaceutical industries, we can talk about just about any other sector. And there is, some kind of level of experience with this. And with AI, this is completely new. So I think that some days I feel like it's only the engineers and the insiders at these companies who really understand the true potential for this. And the rest of us are kind of just taking their cue. Unless you have an engineering background, it's really hard to understand what all this stuff means. But I think that, the CapEx that's going into data center, this is really to build out that computing capacity. And much of this has been obviously on these data centers. We talked about this. Mark Zuckerberg revealed his planned Hyperion mega data center, and it's probably going to be about the size of Manhattan. Elon Musk is talking about building a data center in space. It sounds crazy, but clearly they're seeing that they have to overinvest because they're anticipating the power that they'll leave for AI applications to continue to grow. So I think, if you look at AI in terms of what it can be used for, and this is just very, surface level. So again, I mentioned healthcare. So, potential uses here are diagnostics, personalized care, operations, and that means improved accuracy, faster drug discovery, more tailored treatments, reduced wait times. There's a Google application now in AI where the breast cancer screening success rate is 96%. That's huge. Transportation logistics, thinking about obviously greater efficiency, lower costs, safer vehicles, autonomous vehicles. We're talking about drones doing last mile delivery. It sounds nuts, but I don't think we're that far away. Manufacturing, obviously, supply chain improvements, things like that. So I think it's not a technological development that will only impact one industry. It's going to have far-reaching implications for the entire economy. And so that's why I think it's like the railroads. I think this is something that is, again, it's a game changer. It's a revolution. And I do think that to a certain extent, the CapEx is warranted. Now, where we get concerned, obviously, is if, the CapEx is built on a mountain of debt. And we're not there yet. I think that's something we'll have to watch really, really carefully. But it does sound like a lot of money. I think, NVIDIA's market cap just reached $5 trillion. That's larger than the GDP of Germany. So you hear these numbers and I get it. Of course it sounds like a bubble. But I think if you look at the fundamentals, if you look at what this can be used for and how quickly this is moving, it does make sense. But again, I'm more worried about the concentration. So for me, I do think the sector is going to continue to perform. But if there's any market sentiment or noise that does cause a pullback, even unrelated to the fundamentals of these businesses, I think that's where we'll experience a lot of pain. So people and investors, they need to diversify. You can't just put all your money into the S&P 500. You got to look outside of that and invest in other asset classes. Private markets, gold is one, commodities obviously, as well as fixed income. So I think that's just something people always have to keep in mind.
Yeah, I think you're absolutely right. I think diversification is always so important when you've got valuations where they are today in that sector. But it sounds like what you're saying is there's a lot of reasons to continue to believe that we're in the early innings here of something bigger. And I think your points on the spillover to non-tech, I'm glad you brought that up because I think that's so important. And that's not getting talked about as much, right? Which is the other sectors that are actually benefiting from AI adoption that we may see in 2026.
Absolutely. And I think we saw that with Walmart kind of saying, hey, look at me. They're benefiting from their expedited, grocery services. Like they've spent tons of money on agentic AI. I think, yes, there's the AI play where you're buying the actual manufacturers of the chips and the hyperscalers, but there's also a play where you're investing in those businesses or sectors that are doing a great job at adopting it. Because that means for them, lower cost structure, better client service, better margins, and more innovation. That's the other side of it. But yeah, again, everyone talks a lot about Meta and NVIDIA.
Yeah, for sure. It seems to be where NVIDIA goes, the market goes, or the market follows, right? So now moving on to your second theme, K-shaped economy. You're right. Andrew Sumerk and I, in our last podcast, did talk on the K-shaped economy. But I wouldn't mind your perspective on portfolio positioning and capital allocation. So given the K-shaped economy, does it favor certain sectors, or how do you think about it when you think about the K-shaped economy and allocation, keeping in mind our bigger theme of diversification?
Yeah, absolutely. So this K-shaped economy. So for folks who are unfamiliar with this concept, just imagine like kind of a K, and the top arm of the K represents those who are thriving. So these are typically educated, higher income individuals with stock portfolios, retirement plans, 401s, as well as certain industries like tech, AI, financial services, and they'll see significant growth in wealth creation. While the bottom arm really represents kind of the lower income individuals and sectors such as maybe, hospitality, retail, or kind of more mature industries like manufacturing, things like that, that aren't going to benefit as much. So I think when you're looking at those sectors, again, in terms of diversification, you can't have all your eggs in one basket. So you have to, I think there's opportunities in that bottom arm. I think there's always overlooked sectors and overlooked businesses and plays for value with discounted cash flows and things like that, or discounted valuations that are attractive. And we've invested in one of these managers and they've done a great job. What's interesting about this manager is they have no AI or tech investments and they've returned 30% because their objective is just purely to buy companies where they see deep value, where they see that, they've been overlooked for whatever reason. They're not the favorite darling, but they're strong producers. They've got great tailwinds and solid management team. So I think the bottom up fundamental analysis is really important, and you can't ignore certain sectors that are in that kind of bottom arm because I think there's a lot of interesting kind of momentum there. And as well, you have to look outside the US. The US is obviously a big percentage of global market cap, but there are some interesting sectors in Europe and Japan. I mean, if you look at the European banks, they've actually outperformed many of these tech companies. So I think it's important to work with an advisor, a dealer that have that bench strength and understand that those opportunities for geographic exposures elsewhere. So I think that's a big part of it because I think with the US, the K-shaped economy, I think they're going to have more challenges from a societal perspective going forward because again, that wealth disparity is going to grow. And I think that will have huge implications. Like already Trump has exempted groceries and coffee, and you're starting to see that kind of pressure. So I think the K-shaped economy is not going anywhere as long as AI continues to outperform. And I think there's still a lot of people that are overly concentrated in that space.
Yeah, and I think that's right. I think there's a lot of people in passive investments in ETFs. And I think right now, I think this might be a good segue for us to talk about heading into 2026. Due diligence around the businesses that you own or the securities you hold will be even more important. So that takes me to 2026 and your thoughts as we look ahead to 2026. What are you watching? What are you thinking about? And as one of my clients likes to say, what keeps you up at night?
Wow, yeah, exactly. So obviously, I mean, market concentration keeps me up. If there is a AI pullback, what does that mean? And are there implications for contagion or anything like that, right? So that's a big one. But I think if you have a well-diversified portfolio and you're taking a longer term view and not a kind of market timey approach, I think if that happens and if there's some noise, you'll be able to withstand that. So I think that's, as long as you're well diversified, that keeps me up less. What I do think about is the new global trade order, because I do think this is Act Two, let's call it that. It's not so much about if tariffs will come. Now, we know they're there. We now have a completely protectionist agenda in the US with obviously Trump's advisors. He's surrounded by pro-tariff advisors there. So I think, we can accept that that's now the status quo. But I think it's about like how that impact will be felt. There's a lot of companies in the US that have been absorbing tariffs. They haven't passed them down yet to the consumers. I think in some sectors you're seeing kind of tighter margins, although corporate earnings are generally strong. So I think that's a big factor that we need to look at. And I think what happens with China in terms of trade negotiations. So on October 31st, Trump and President Xi, they met, they discussed economic concerns, they negotiated a trade agreement. I wouldn't even call it agreement. I call it a truce, really, between the two countries. They've decided to roll back some of the tariffs that they implemented around Liberation Day, and China has agreed to ease the export restrictions on these critical minerals. But I think it remains to be seen how long this accord really lasts. I think, the détente that they reached earlier 2025 didn't really survive that long. And these are two of the world's greatest powers, and they're pretty frosty towards each other. I'm pretty certain that they both want to dominate globally. Their agenda is to be self-reliant. And so I still think that that's a big question mark. And that will have far-reaching implications for not just the US, but I think elsewhere. I think Canada is actually doing a decent job of trying to diversify its trading partners. With the new budget, I think we're making the right investments internally in terms of resources and oil and gas and looking to get that to other partners through these new trade corridors. And I think we have to do that, frankly. But I think what happens with China will have pretty kind of ripple effects. The second thing that keeps me up, I guess, is what the Fed will do. I do think now that they're going to cut, I think markets are now pricing in an 85% chance of a cut. I think it was closer to 40% probably a week ago. So we'll see what happens there. And then maybe the chair will be replaced. So they're talking about Kevin Hassett. So I think that will be something we need to look at because while the tech sector is doing really well, there are some businesses that would really benefit from lower interest rates, but not so lower that inflation starts to rear its head again. And I think that's something that could be concerning. On the private market side, I think actually this is kind of a good turn of events for private markets. I think deal momentum will return. We've already seen an uptick in M&A and IPO activity. So I think that means that valuation gaps have narrowed. We're going to see more transactions, particularly in private equity, where some of these kind of assets have been frozen because of these valuation gaps and the fact that interest rates were high, making debt more expensive. So I think we're going to see some nice realizations in that space and an increase in activity. Obviously, there's still some potential landmines there, as always, particularly for retail investors. You really have to understand the illiquidity of these markets and these asset classes. So you have to go in with your eyes wide open and make sure that you've got the right advisor guiding you to any investments in private markets. I think that's really important. But I do think there's some opportunities in that space going forward.
That's amazing. Thanks. I think sadly our time is coming to an end here. So given everything that we've covered, AI, the K-shaped economy, the narrow market leadership, and then as you said, the continued importance of the Fed as we head into 2026, How are you feeling? Are you feeling more optimistic, more cautious, or just it sounds like you're simply feeling realistic or balanced in terms of forces in the market and stressing the idea of continue to stay diversified? But over to you to maybe wrap up here for our listeners.
Yeah, absolutely. I'd say I'm feeling more positive probably than I did in February and March. I think when Trump took office and was, let's say his tariff approach was a bit more chaotic and aggressive. And I think media headlines were less about, obviously AI and more about like how the Canadian economy was going to be completely crushed. And I found that more concerning back then. And then it kind of, like you said, like at Liberation Day, it kind of peaked in terms of, I think, our anxiety. And then maybe after that, with what happened with the markets, after that, I think the US administration has taken a more measured approach, maybe recognizing that these types of announcements about, 150% tariffs and things like that probably isn't good for equity markets. I think I feel better about it now, absolutely. And some agreements are obviously being negotiated. There's been progress. Canada continues to pay lower tariffs because of CUSMA. I think we'll see what happens when that comes up for renegotiation. But I think there's less concern or anxiety around that. And I'm getting a bit more, I think, not excited, but maybe excited about sort of what's happening in the AI spaces. I think this has become more top of mind. And as we learn more, the applications of how it can be used, it's pretty exciting. But again, we have to be cautious. We have to be rational about what the potential there is and the upside is. But I do think it'll have pretty significant impacts on, like, again, not just these tech companies, but everywhere. So I'm very kind of at least intellectually curious about how all of this shakes out. And I think we are in the early innings. I think there's going to be a wobble here and there. But I think that the equity markets are going to continue to perform. But I do have some concerns about US Fed policy and things like that, because I think that could reignite inflation. And I think that's something that we really have to keep under control.
Yeah, and I think part of investing is, unfortunately, volatility. And for the long-term investors, volatility is just something that comes with having a long-term mindset. So I think that's absolutely right. Excellent. Great. I think that's a perfect place to leave things then, Theresa. Thank you for joining us today. I really appreciate your insights.
My pleasure. Thank you, everyone.
And thank you to our listeners for joining. We'll be back next month with another issue of our KJH Insights podcast. If you have any questions, please reach out to your portfolio manager or anyone on the investment team, and we'll continue to provide you with commentaries as the market narrative unfolds. All of those are available on our website at kjharrison.com. Look forward to speaking to you again next month. Take care.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.